Hey everybody, Dr. Phil here. So this is going to be a video on exploratory business analytics. So we're going to be looking at descriptive and diagnostic analytics. First thing I want to do, I mentioned this in a previous video, but the first thing I wanted to do is just very quickly very briefly run through the five types of analytics, if you will. So descriptive analytics is what happened, what is happening, right? Diagnostic analytics, why did it happen? What are the causes for past results? Why are results different than expectations? The third is predictive analytics. What will it happen in the future? What's the probability something will happen? And can we forecast what will happen? The next one is prescriptive analytics, the fourth one. What should we do based on what we expect will happen? And how do we optimize our performance based on potential constraints? And fifth, but not last, adaptive analytics. How can we continuously learn using artificial intelligence, AI? Can we learn from past and current events with adaptive learning? So exploratory data analytics as initial descriptive and diagnostic data analytics investigations to summarize and explain performance and activity. So exploratory analytics explores the data, think about the name exploratory, and begins to generate questions and hypotheses that need further explanation. Exploratory data analytics includes the practice of exploring the data by summary performance statistics, anomaly identification, I'll talk about that more later, and pattern detection. So like correlations as an example. Confirmatory data analytics are predictive and prescriptive analytics that use statistics to judge the likelihood or probability of a future event or outcome occurring. So descriptive analytics addresses the questions of what happened or like what is happening. We define descriptive analytics as analytics performed which characterizes, summarizes, and organizes features and properties of the data to facilitate understanding of the results and the underlying data. So human resource management systems, HRMs, is an information system for managing all interactions with current and potential employees. Now, some examples, this is not an exhaustive list, but some data that could be included, recruiting data and leads, employee training, current and desired certifications, payroll and compensation, including tax elections like 401k contributions, number of dependents, amount of state and federal withholding, etc., and employee benefits, stock options, bonuses, health insurance, etc. A customer relationship management CRM system is an information system for managing all interactions with current and potential customers. Now, the data included could be, again, this is not an exhaustive list, customer contact history, what happened in the interaction, what they asked about or what was decided, any interest in new products or services, the customer order history, customer level of trade discounts or payment terms, and customer credit score. So is their credit improving or declining? Another example would be supply chain management systems, SCMs. So a company's supply chain is the sequence of processes to get a good or product from original production to final customer for delivery. The system used to track these supply chain processes is called supply chain management systems. Now, data here could include active vendors, so contact info, where payments should be made, how much, the orders made to date, how much, when they were made, and demand schedules for what component of the final product is needed, when and where. Another one would be financial reporting systems or accounting systems. So these are systems that capture and measure financial transactions and communicate financial performance to interested parties. And obviously, there's a lot of those, right? Creditors, stockholders, regulators, etc. Financial statements are collections of reports that communicate a company's financial results, financial condition, financial health, and its cash flows. So what you're seeing here is very common in the world of accounting and certainly finance, what we call horizontal analysis. So horizontal analysis is a descriptive analysis technique that calculates and displays the dollar and percentage change in financial statement line items from one period to the next. So if you look at what they've got here, 2019, 2020, and they're just calculating the change, right? So what we could say if we look at sales, sales increased by $38.64 amount, or we could say 8.95%. And we would, of course, just use the, new minus old divided by old formula, like always. Vertical analysis, this examines financial performance over a period of time by expressing financial information in relation to some relevant figure or base. So in this example, this is very typical in the accounting realm. Sales is typically used as the 100%. So everything you see here is based on sales. So like if I pick like cost of sales, um, like 86.13, 87.53, we would just take these like the 40,523 and divide it by the 47,049. That would give us the 86%, so on and so forth. So diagnostic analytics. So this is performed to investigate the underlying reasons for past results that cannot be answered by simply looking at the descriptive data. So perhaps we've looked at the descriptive data, we haven't found answers to what we were looking for, so we're looking to be a little more diagnostic. So diagnostic analytics is broken down into two broad categories to help determine why something happened. So the first one is identifying anomalies and outliers. That's a statistical term. And then finding previously unknown linkages, patterns, or relationships between variables. So, for example, performing drill down, detailed analytics, also performing statistical analyses. So, with respect to identifying anomalies and outliers, sometimes analysts use diagnostic analytics to help find what we call an anomaly. You've probably heard that term before, like something out of the ordinary, which is something that departs or deviates from the expected or the norm. In many ways, an outlier is similar to an anomaly if it's an observation or a data point that lies outside its expected distribution. It could just be a mistake or the result of a fraud, or it could be truth. To detect an anomaly or an outlier, it's important to establish the norm or the expectation. Now here we see what's called Benford's law. So the theoretical distribution of the first digit of a set of naturally occurring numbers. So all this to kind of say, I just thought it'd be cool if you got to see this. The first digit, number one, there's basically a 30% probability that the first digit in a number will be one. So as you can see, these numbers, as you go down, 1, 2, 3, 4, as you work your way down, you notice that the values get lower. So it's almost like in a quote unquote randomly set of occurring numbers, then one has got the highest chance of being first, so on and so forth. Performing drill down analytics. So by looking for patterns in the underlying data set or an external data set, we potentially can identify correlations. Drill down analytics works to summarize data at different levels and uncover additional details to understand why something happened. Now, performing statistical analysis, this category of data analytics works to uncover statistical patterns in the data or how data moves together. So if we drill into the analysis, why would we want to do that? Well, to help explain why or how something has occurred. So some examples could be analysis of the highest owing customer. So, which customers included in the total accounts receivable have the highest balances outstanding? Do some accounts need to be written off due to uncollectability? Another example could be analysis of the most profitable customer. By learning which customers are most profitable, the company can better work and cater to these customers. And then analysis of the most profitable product. By learning which products are most profitable, the company can better promote them to their customers. At the same time, they will be learning which products are not profitable and either work to make them more profitable, like raise the sales price, get product from another cheaper source, or perhaps just remove that product altogether. The last thing, or the next thing I wanted to talk about was hypothesis testing. I've kind of mentioned this in another video, but I wanted to just touch on it here. Testing a difference in means. So are mean production cycle times in the Philippines the same or different from mean production cycle times in Vietnam? So that's sort of the question, if you will. Well, hypothesis testing, one example of a statistical tool they might use for that would be regression. So is employee turnover associated with rapidly rising wages in the economy? So a couple of different examples there of statistical tools that you could potentially leverage in order to help you answer a question. All right, that's it for today. Thanks for watching and take care. Goodbye.